Now we're going to explore a critical concept that directly builds on everything we just covered about market state identification, how volume profile levels actually behave differently depending on whether the market is in balance or imbalance. This is where theory meets practice. Understanding that the market has two states is one thing, but knowing how to read and trade the same level differently in each state is what transforms you into a professional discretionary trader. The core principle here is simple but profound. Volume profile levels behave differently depending on market state. The same previous day value area high can act as an impenetrable wall in balance, but get blown through like it doesn't exist during imbalance. The same point of control can be a powerful magnet pulling price back during ranges, but become completely irrelevant during strong trends. Your job is to recognize the state first, and then adjust how you read and trade the levels accordingly. Let's start with how levels behave in balance when the market is in fair value or equilibrium node. During balance, the value area high and value area low act as firm walls. These aren't just levels that price touches and maybe respects, they're boundaries that repeatedly contain price action. When the market is rotating in balance, the VAH acts as strong resistance. Price approaches it, gets rejected, and drops back toward the center. Similarly, the VAL acts as strong support. Price drops to it, finds buyers, and bounces back up toward the POC or VAH. This happens not just once, but multiple times throughout the session. You can watch the market ping-pong between these boundaries with remarkable consistency. Why do these boundaries hold so well in balance? Because participants have agreed on the value area. The VAH represents the upper edge of fair value. Beyond that, price is considered expensive and sellers step in. The VAL represents the lower edge. Below that, price is considered cheap and buyers step in. This collective agreement creates the firm boundary behavior you observe. It's not magic, it's market structure. Your tactical approach during balance is to fade the edges and target the opposite boundary. When price pushes up near the VAH and shows rejection signals, a strong wick, a reversal candle, or simply failure to hold above, you take short positions targeting the POC or the VAL on the opposite side. When price drops near the VAL and shows acceptance signals, buyers stepping in, bullish candle closes, you take long positions targeting the POC or the VAH. This mean reversion strategy works beautifully in balance because the boundaries are reliable. You have a defined range, clear entry signals, and a high probability that price will revert to the center. The point of control also behaves distinctly during balance. The POC becomes the gravitational center of the range. It's the magnet pulling price back from the edges. When price extends to the VAH and reverses, it often drops all the way back to the POC before finding support and bouncing again. When price drops to the VAL and bounces, it rallies back to the POC before encountering resistance and reversing. This oscillation between the VAH, POC, and VAL creates the classic range trading rhythm. Your tactical approach with the POC during balance is to use it as both a target and a pivot. If you're fading the VAH with a short, your primary target is the POC. If you're fading the VAL with a long, your target is the POC. And when price reaches the POC, that's often your signal to either take profits or reassess. Will it continue to the opposite edge, or will it reverse here? The POC in balance is your anchor point for mean reversion trades.
Now let's shift to how levels behave in imbalance when the market is in price discovery or trending mode. During imbalance, price breaks beyond the value area boundaries and holds. This is the defining characteristic. The old VAH doesn't act as firm resistance. It gets broken decisively, and price doesn't reverse back into the old range. Similarly, the old VAL doesn't act as firm support. It gets broken, and price continues lower without bouncing back. The boundaries that contain price during balance lose their power during imbalance because the market has decided that the old fair value range is no longer valid. Price is seeking new value zones. When you observe this break and hold behavior, it's your signal that the market has transitioned from balance to imbalance. The VAH or VAL may provide a brief pause, perhaps a single candle hesitation or a small pullback, but they don't contain price. The move continues with momentum. This is the freight train we keep warning you about. If you try to fade the VAH during strong bullish imbalance, thinking it will act like it did in balance, you'll get steamrolled. The level isn't acting as a wall anymore. It's acting as a speed bump. Your tactical approach during imbalance is to trade with momentum, not against it. You're not fading the edges. That's financial suicide. Instead, you're following the directional bias. You wait for pullbacks to broken levels and use those as continuation entry opportunities. This brings us to the second critical behavior during imbalance. After price breaks a value area boundary, pullbacks to flipped levels become high probability entry zones. Here's how this works. Let's say the market is in bullish imbalance and breaks above the previous day VAH. Price continues higher, establishing a new higher value area. Then, after some time, price pulls back slightly. Where does it often find support? At the old PDVAH that was just broken. That level has now flipped from resistance to support. This pullback to the flipped level is your entry opportunity to go long and ride the continuation higher. Why does this work? Because the broken boundary becomes a new reference point. Participants who missed the initial breakout see the pullback as a second chance to enter. Those who are already long see the broken level holding as confirmation that the move is real. The collective behavior creates support at the old resistance or resistance at the old support, depending on direction. Your tactical approach is to enter on pullbacks to flipped levels in the trend direction. If the market broke above the VAH and you missed the initial move, you wait for a pullback to that broken VAH. When price tests it and shows signs of holding, perhaps a bullish candle, buyers stepping in, you go long, targeting the next structural level higher or the new developing value area. This is momentum trading with confirmation. You're not chasing the breakout blindly, but you're also not fighting the trend. Here's the critical principle that ties everything together. Strategy follows state. Before you place any trade, you must identify the market state first. Is this balance or imbalance? Is the value area stable or shifting? Is the POC sticky or migrating? Once you answer those questions, the level behavior becomes predictable and your tactical approach becomes clear. In balance, fade the edges, trade the range, use the POC as your target. The boundaries are firm. Mean reversion is your edge. In imbalance, don't fade a freight train. Trade with momentum. Use pullbacks to broken levels as entries. The boundaries are permeable. Continuation is your edge. The biggest mistake traders make is applying the wrong strategy to the state. Fading extremes in imbalance gets you run over. Trying to catch breakouts in balance gets you chopped up by reversals. But when you correctly identify the state and trade the levels appropriately, your win rate improves, your risk-reward improves, and your confidence improves because you're flowing with the market instead of fighting it. How do you develop this skill? Through screen time and deliberate practice. Go back through your charts and label sessions clearly. This was balance. Note how the VAH held repeatedly. This was imbalance. Note how the VAH broke and became support on the pullback. Build a mental library of examples. Over time, your brain will recognize the patterns instantly, and you'll know exactly how to read and trade the levels based on state. Next, we'll explore how to read developing volume in real time as it builds throughout the session, so you can anticipate state transitions and adjust your strategy dynamically before most traders even realize the market has changed.
Developing volume is one of the most powerful real-time tools in volume profile trading. While most traders rely solely on prior day levels, PDVAH, PDVAL,
PDPOC, developing volume, shows you what's happening right now in the current session. It's the difference between driving with a rear-view mirror and actually looking at the road ahead. This slide covers how to read developing volume in real time and what patterns to watch for as the profile builds throughout the session. Core concept: the living profile. Developing volume means watching your volume profile build tick by tick, candle by candle as the session progresses. Instead of waiting until the close to see where volume accumulated, you're monitoring the profile's evolution in real time. This gives you three critical advantages. First, early warning of market state. You can see whether the market is in balance or imbalance before the session ends. If the value area is expanding with a centered POC, you know you're in a range. If the value area is shifting and the POC is migrating, you know you're in a trend. Second, real-time confirmation or conflict with prior levels. Your developing profile might confirm that a PDVAL is holding a support, or it might show that volume is building above the PDVAH, signaling a breakout. Third, dynamic adjustment of your approach. As the profile develops, you can adapt your strategy, switching from fade the edges to trade with the move, or recognizing when to sit on your hands because the market is choppy and indecisive. Let's configure our tools now. Tool setup: fixed range volume profile with extend right. To monitor developing volume, you need to set up your volume profile tool correctly. Here's the exact configuration. First, use fixed range volume profile, not session volume profile. Fixed range gives you control over the time window you're analyzing. Second, set the range to cover the current session from the open to the current moment. For the New York session, set your fixed range from 9:30 a.m. to current time. For the overnight session, set it from 6 p.m. to current time. Third, enable extend right or real-time update if your platform supports it. This setting makes the profile update continuously as new volume comes in. You'll see the profile evolve in real time rather than waiting until you manually refresh. Fourth, keep this developing profile on your chart alongside your prior day levels. This allows you to compare what happened yesterday with what's happening today. Now let's cover the three key patterns to watch for in developing volume. Pattern 1, POC magnet effect. Watch where the point of control forms in your developing profile and observe how price behaves around it. If the POC stays relatively stable and sticky as the session progresses, price will tend to gravitate toward it. You'll see repeated tests of the POC, with price pulling back to it after moves away. This POC acts as a magnet, the center of gravity for the current session. Trading implication: the developing POC becomes a key reference level for the day. If you're long and price pulls back to the POC, that's often a support zone to add or hold. If you're short and price rallies to the POC, that's often a resistance to add or hold. But here's the critical distinction. If the POC stays sticky near the same price level, that signals balance. If the POC migrates, moving higher in a bullish trend or lower in a bearish trend, that signals imbalance and trend. Pattern 2. Value area expansion and contraction. The second pattern is value area behavior, specifically whether the value area is expanding or contracting as the session progresses. Value area expansion. The VAH and VAL boundaries move farther apart as the session develops. This indicates broader participation across price levels. Volume is accumulating across a wider range, meaning the market is finding acceptance at multiple prices. But here's the key insight. Watch how the expansion occurs. Is it symmetric, with both the VAH and VAL expanding outward equally around a centered POC? That's a sign of balance and range-bound conditions. Or is it asymmetric, with only one boundary expanding significantly while the other stays stable? That's a sign of directional bias and trending conditions. For example, if you see the VAH expanding upward while the VAL stays relatively stable, that's bullish asymmetric expansion. The market is accepting higher prices and rejecting lower prices. Conversely, if the VAL is expanding downward while the VAH stays stable, that's bearish asymmetric expansion. The market is rejecting higher prices and coiling toward the downside. The pattern of expansion or contraction, symmetric versus asymmetric, tells you about directional intent and market state. We'll break down these four patterns in detail on the next slide, but for now, just know to watch which boundaries are moving and how fast they're moving. Pattern 3. New HVNs and LVNs in your developing profile. High volume nodes. As the session progresses, watch where new HVNs form. These are price levels where volume is accumulating, where buyers and sellers are actively transacting. New HVNs act as magnetic levels for future price action. If a new HVN forms above your current price, it can act as resistance. Price may pull up toward it. If a new HVN forms below your current price, it can act as support. Price may pull down toward it. HVNs represent acceptance zones where the market is saying this is fair value. Low volume nodes, conversely, watch where LVNs form. These are price levels where volume is low, where price moved quickly without much trading activity. LVNs often act as continuation zones. If price returns to an LVN, it tends to move through it quickly rather than finding support or resistance there. In trending markets, you'll see a trail of LVNs left behind as price moves directionally. These LVNs show rejection. The market moved through those levels fast because participants didn't find them attractive. In balanced markets, you'll see HVNs forming at multiple levels across the value area, indicating two-sided acceptance.
Developing volume can serve as either confirmation or conflict with prior levels, making it a powerful decision-making tool. Imagine you're watching for a long entry at a prior day value area low, or PD val. If your developing profile shows the point of control, or POC, forming right at that PD val with a high volume node building, that's a strong confirmation. This indicates that today's participants are finding value at that level. On the flip side, if the POC has migrated above the PD val and a low volume node has formed at the PD val, it indicates conflict. This conflict suggests that yesterday's level is now irrelevant. In such scenarios, developing volume often overrides prior levels because it reveals the current market reality. Remember, focus on where volume is building today, not just where it built yesterday. Key question: where is volume building right now? This will guide your trading decisions. Developing volume in real time is crucial. It's a skill honed with screen time and pattern recognition. Start by setting up your fixed range volume profile and watch how the POC and value area shift throughout the trading session. Note when the market transitions from balance to imbalance or when it confirms or conflicts with prior levels. Save your observations, review them, and over time, you'll develop the instinct to read developing profiles at a glance. Next, we will explore the intricate patterns of value area expansion and contraction and how they inform market state and directional intent. Understanding value area behavior as it develops in real time is critical for reading market state and anticipating the next move. This slide covers two fundamental patterns, value area expansion and value area contraction. But here's the key insight most traders miss. Both expansion and contraction can be either symmetric or asymmetric, and this distinction reveals directional intent before the breakout occurs. Let me break down all four patterns in detail so you understand exactly what to look for and how to trade each scenario. Part 1. Value Area Expansion, the two types. Value area expansion occurs when the value area widens as the session progresses, but expansion can happen in two very different contexts: sideways balance or trending imbalance.
The pattern of expansion tells you which context you're in, and therefore which strategy to deploy. Pattern 1. Symmetric expansion, sideways balance. Symmetric expansion occurs when both the VAH and VAL boundaries expand outward equally. This signals that the market is in balance, with two-sided acceptance across a broader price range. Here are the key characteristics. First, both VAH and VAL expand outward equally. You'll see both boundaries moving farther apart at roughly the same rate. For example, if the opening 30-minute value area was 10 points wide, by midday both boundaries might have moved outward 5 points each, creating a 20-point value area. Second, the POC remains sticky near the center. This is the critical tell for symmetric expansion. The point of control stays near the middle of the value area as it expands. If you overlay multiple 30-minute profiles throughout the session, the POC should cluster within a tight range at the center. Third, volume is distributed across a wider bell curve. The volume profile shows multiple high-volume nodes spread across the range, creating a balanced bell-shaped distribution. This indicates active trading at multiple price levels, not directional flow. Price rotates between the boundaries. You'll see clear swings from VAH down to VAL and back up toward the POC or VAH. These rotations confirm the range-bound mean reversion environment. Neither bulls nor bears can sustain control beyond the boundaries. The market is finding balance and fair value across a broader range. Expansion in a centered value area indicates acceptance at current price levels and equilibrium between supply and demand. Both sides are actively transacting, creating stability. The trading strategy for symmetric expansion: fade the edges and target the POC. When you see expansion with a centered POC, you can trade mean reversion. Sell near the VAH, buy near the VAL, and target the POC as your profit zone. The wider the value area, the more room you have for profitable swings between the boundaries. This is the classic balance scenario, where structure holds, levels matter, and rotation is the name of the game.
Now let's look at the opposite scenario, asymmetric expansion, which occurs when only one boundary expands significantly while the other stays relatively stable. This pattern signals trending imbalance and directional acceptance at new price levels. First, one-sided expansion. Only the VAH expands significantly in a bullish trend, or only the VAL expands significantly in a bearish trend. For example, in a bullish trend, the VAH might move from 45.30 to 45.45, while the VAL only moves from 45.20 to 45.22. The expansion is concentrated on one side. Second, the POC begins to migrate in the expansion direction. This is the critical difference from symmetric expansion. In asymmetric expansion, the POC doesn't stay centered. It moves in a staircase pattern with price. If you overlay multiple 30-minute profiles, you'll see the POC climbing higher in a bullish trend or stepping lower in a bearish trend. Third, new HVNs form at progressively higher or lower levels. The volume isn't distributed evenly, it's accumulating directionally. In a bullish trend, new HVNs form above the previous POC. In a bearish trend, new HVNs form below. Fourth, low volume nodes are left behind. As price moves quickly through certain levels, LVNs form in the wake of the trend. These gaps in the volume profile show where price wasn't accepted and moved fast. LVNs often act as continuation zones on pullbacks. Fifth, breaks and holds beyond boundaries. In asymmetric expansion, price doesn't rotate back into the value area after breaking out. Instead, it breaks the VAH or VAL and holds beyond, establishing a new higher or lower value area. The trading strategy for asymmetric expansion: trade with the move, using pullbacks to continuation levels. Don't fade the edges in this environment. You'll get run over. Instead, wait for breakouts to broken levels or new HVNs that formed above the old POC. That pullback is your entry for continuation long. The old resistance becomes new support in trending markets. The key distinction: symmetric expansion says fade the edges because the market is balanced. Asymmetric expansion says trade with the move because the market is trending and directionally accepting new price levels. Homework Task 1. Find an expansion example. Your first homework task is to locate a real example of value area expansion from your charts and classify it as symmetric or asymmetric. Here's your 4-step checklist. Step 1. Locate a session where the value area widened by 50% or more. Use your volume profile tool set to the full regular session to measure the opening range versus the final value area width. Step 2. Classify it as symmetric or asymmetric. Ask yourself, did both boundaries expand equally with a centered POC? That's symmetric balance. Or did one boundary expand significantly more with POC migration? That's asymmetric trend. Step 3. Identify the characteristic behavior. For symmetric expansion, mark the price rotations between VAH and VAL, at least 2 clear swings. For asymmetric expansion, mark the staircase POC migration and the LVNs left behind. Step 4. Screenshot and label your example. Capture the full session profile and annotate it clearly. Label it as expansion symmetric or expansion asymmetric, depending on what you found. Save this to your value area behavior library.
Now let's shift to value area contraction. Contraction occurs when the value area remains tight and narrow as the session progresses. This pattern reflects limited participation and low volume distribution. The market is in a holding pattern and pressure is building for a directional move. But just like expansion, contraction can be symmetric or asymmetric, and this distinction tells you whether the coming breakout direction is uncertain or predictable. Symmetric contraction occurs when both the VAH and VAL compress inward toward the POC equally. This pattern signals neutral coiling with no directional bias. The market is truly undecided, and the breakout direction is uncertain. Here are the key characteristics. First, both VAH and VAL move inward equally toward the POC. The value area stays tight throughout the session, with both boundaries compressing at roughly the same rate. For ES, if the typical daily value area is 15 to 20 points, a symmetric contraction might be only 8 to 10 points, with both boundaries equidistant from the POC. Second, no directional bias. Price isn't rejecting one side more than the other. There are no strong rejections at the VAL pushing price up and no strong rejections at the VAH pushing price down. The market is balanced in its indecision. Third, low volume and limited participation. The volume profile shows a sharp, narrow spike concentrated near the POC. Most traders are sitting on the sidelines waiting for more information before committing capital. Fourth, tight, choppy price action. You'll see small-bodied candles clustering near the POC with minimal range. Price oscillates within a few ticks of the center without making decisive moves toward either boundary. Fifth, pressure is building for a breakout. Symmetric contraction is like a coiled spring. The longer it stays compressed, the more energy builds for an eventual expansion. But the direction of that expansion is uncertain until the break occurs. The trading strategy for symmetric contraction: wait for breakout confirmation before committing. Don't try to predict which way it will break. Let the market tell you. Once price breaks decisively above the VAH or below the VAL with a volume spike, then trade with the breakout, or wait for the retest of the broken level and enter on the continuation move. Asymmetric contraction occurs when one boundary compresses faster than the other, revealing directional bias before the breakout occurs. This is one of the highest probability setups in volume profile trading. There are two scenarios. For bullish coiling, the VAL tightens upward faster than the VAH moves down. This shows that lower prices are being rejected. Sellers can't push price down. The market is coiling toward the upside, and an upside breakout is more likely. Visual example, opening value area is 45.15 VAL to 45.35 VAH, 20 points wide. By midday, the VAL has compressed up to 45.25, while the VAH has only compressed down to 45.33. The value area is now 8 points wide, but the VAL moved 10 points up, while the VAH only moved 2 points down. That's bullish coiling. For bearish coiling, the VAH tightens downward faster than the VAL moves up. This shows that higher prices are being rejected. Buyers can't push price up. The market is coiling toward the downside, and a downside breakout is more likely. Visual example, opening value area is 45.15 VAL to 45.35 VAH, 20 points wide. By midday, the VAH has compressed down to 45.25, while the VAL has only compressed up to 45.17. The value area is now 8 points wide, but the VAH moved 10 points down, while the VAL only moved 2 points up. That's bearish coiling. The key characteristics of asymmetric contraction include one boundary compressing faster than the other, clear rejection patterns on one side, and revealed directional bias before the breakout. The trading strategy for asymmetric contraction, position for the breakout in the direction of the bias. If you see bullish coiling with the VAL compressing upward, prepare for an upside breakout. If you see bearish coiling with the VAH compressing downward, prepare for a downside breakout. You can either enter on the initial breakout with a volume spike, or wait for the first retest of the broken level and enter on the continuation move.
Slide 28. Value Area Expansion and Contraction, Part 4 of 4. Homework Task 2. Find a contraction example. Your second homework task is to locate a real example of value area contraction from your charts and classify it as symmetric or asymmetric. Here's your 4-step checklist. Step 1. Find a tight value area that's narrower than the average daily range. Use your historical data to compare. If typical sessions show 15 to 20-point value areas, look for sessions with 8 to 12-point value areas or less. Step 2. Classify it as symmetric or asymmetric. Ask yourself, did both boundaries compress inward equally toward the POC? That's symmetric neutral coiling. Or did one boundary compress significantly faster than the other? That's asymmetric directional bias. Step 3. Identify the characteristic behavior. For symmetric contraction, note the tight clustering near the POC with no clear rejection pattern on either side. For asymmetric contraction, identify which boundary compressed faster and mark the rejection patterns, lower wicks for bullish coiling or upper wicks for bearish coiling. Step 4. Screenshot and label your example. Capture the tight value area, the coiling action, and the subsequent breakout. Annotate the chart clearly showing the contraction zone, which boundary compressed faster if asymmetric, and the eventual breakout direction. Label it as contraction, symmetric, or contraction, asymmetric bullish, or contraction, asymmetric bearish. Save this to your value area behavior library. Key insight: contraction near major levels. Here's a critical insight that ties everything together. Contraction near a major previous day level or weekly level often precedes a decisive move. When you see a tight value area forming right at a PDVAH, PDVAL, PDPOC, or weekly POC, that's a high probability setup.
But now you have additional information. Is the contraction symmetric or asymmetric? If it's symmetric contraction at a major level, the breakout direction is still uncertain. You'll need to wait for the break to confirm direction. But if it's asymmetric contraction at a major level, now you have a very high probability read. For example, bullish coiling, where the val is compressing upward right at a PD val support level, strongly suggests an upside breakout. The market is rejecting lower prices at a major support zone and coiling toward the upside. Conversely, bearish coiling, where the val is compressing downward right at a PD val resistance level, strongly suggests a downside breakout. The market is rejecting higher prices at a major resistance zone and coiling toward the downside. Trade the retest or continuation. After the breakout, wait for price to pull back to the broken level, now acting as support or resistance, and enter in the direction of the breakout. Alternatively, if the breakout is strong with high volume, you can enter on the first pullback within the new trend. The master principle: symmetry versus asymmetry. Here's the overarching principle that ties all four patterns together. Symmetry implies uncertainty and balance. When both boundaries move at the same rate, whether expanding or contracting, the market is undecided about direction. You either fade the edges in balanced expansion or wait for confirmation in neutral contraction. Asymmetry reveals directional intent. When one boundary moves significantly faster than the other, whether expanding or contracting, the market is showing rejection of one side and acceptance of the other. This is directional bias before the trend becomes obvious. Watch which boundary moves faster. It often points to the winning side before the breakout occurs. In asymmetric expansion, the faster-moving boundary shows which direction is being accepted. In asymmetric contraction, the faster compressing boundary shows which direction is being rejected and therefore which way the breakout is likely to occur. Why this matters? Value area expansion and contraction are two sides of the same coin. Both tell you about participant behavior and market state. But the pattern of expansion or contraction, symmetric versus asymmetric, gives you the additional layer of information about directional bias. The key is recognizing which pattern is developing in real time, so you can adjust your tactics accordingly. Symmetric expansion, fade the edges in balance. Asymmetric expansion, trade pullbacks in trend. Symmetric contraction, wait for breakout confirmation. Asymmetric contraction, position for breakout in the direction of bias. Your homework assignments, finding real examples of both expansion and contraction and classifying them as symmetric or asymmetric, will build the pattern recognition skills you need to make these distinctions instinctively. This is how you develop the ability to read developing volume and adapt your strategy to the market state in real time. Understanding symmetry versus asymmetry is one of the most powerful edges in discretionary volume profile trading. Next slide preview. We'll cover what to do when developing volume conflicts with prior levels, how to resolve contradictory signals, and make confident decisions when your real-time profile shows one thing and your prior day levels show another.
Slide 29. When developing volume conflicts with prior levels. Complete narration. This slide addresses one of the most challenging situations you'll face as a volume profile trader. What to do when your real-time developing volume conflicts with your planned prior day or prior week levels. You've done your homework. You've identified a clean PD val at 45.25 as a potential long entry. The level has strong history. It held multiple times last week. The trend is bullish on higher time frames. Everything looks aligned on paper. But then,
As the NY session develops, you watch your fixed range volume profile with extend right and something unexpected happens. The POC isn't forming at 45.25. Instead, it's migrating down to 45.20 or worse, down to 45.15. Volume is building away from your planned level. The market is telling you in real time that today's participants don't see 45.25 as fair value. This is conflict, and how you handle this conflict separates discretionary traders who adapt from rule followers who get stopped out repeatedly. The core principle is simple but critical. Static levels from prior sessions provide the initial framework, but developing volume in real time is the market's current voice. When conflict arises, you must respect what's happening now. We'll use a three-tier hierarchy to guide your decision-making. Red scenarios require immediate risk reduction or standing down. Yellow scenarios require downgrading to B setup confirmation requirements. Gray scenarios mean skip entirely and protect your capital. Scenario 1. Strong POC migration against your bias. Red alert. This is the most dangerous scenario and requires immediate action. You're planning a long entry at a PD val, but your real-time developing volume shows the POC shifting away from your planned entry level. The POC is migrating lower in a bearish staircase pattern, or it's already established well below your level and staying sticky at that lower price. What this tells you, market participants are transacting elsewhere. They're creating new fair value away from your zone. Your prior day level is being rejected in real time. Action required? Reduce size significantly or stand down entirely. Don't fight live volume migration. If you absolutely must take the trade, reduce your position size to 25% or less, but the better decision is to stand down. The market is giving you real-time feedback that your thesis is wrong. Scenario 2. Prior level plus weak confirmation. Yellow caution. This is a more nuanced scenario that requires tactical adjustment rather than complete abandonment. You're at a valid prior day or prior week level. The level has good history. The trend aligns. But when you watch your developing volume, you see minimal participation, a thin profile, or indecisive value area formation around the zone. Action required? Treat this as a B setup. Wait for stronger confirmation before entry. Wait for a clear rejection candle. Look for HVN formation at 45.25. Look for multiple quick rejections. Scenario 3. No alignment plus choppy structure. Gray zone. Skip entirely. This is the easiest scenario to identify and the hardest to resist trading. Action required? Skip entirely. Protect your capital and your statistics. This is the discipline that separates professional traders from gamblers. When the market doesn't offer a clear opportunity, you don't force one. Let live data inform your risk. Consistent application of this framework improves your win rate, builds confidence, and enhances discretionary skills through pattern recognition and screen time, developing the discretionary skills that allow you to make these conflict resolution decisions confidently and instinctively. Next slide preview. We'll cover how to earn your intuition through systematic pattern recognition and screen time, developing the discretionary skills that allow you to make these conflict resolution decisions confidently and instinctively.
Slide 30 addresses the concept of trading intuition, often misunderstood in discretionary trading. Many believe it's a mystical sixth sense or gut feeling, but both interpretations miss the mark. Intuition, in reality, is compressed pattern recognition earned through repetition. It's the transition from mechanical rule following to confident discretion achieved with deliberate practice. Let me explain how this progression works. What is trading intuition? It's the brain's capability to recognize patterns rapidly, feeling instinctual, but grounded in thousands of pattern exposures that lead to quick recognition, much like experienced driving. Initially, every driving action was deliberate, but over time, as with trading, these actions become automatic, converting learning into instinct. Trading intuition comes from extensive practice, hundreds of trades analyzing POC behaviors, value area movements, and key rejection candles. You begin to sense when something is off, the POC migration, thin volume, or choppy structure, without needing detailed analysis. This intuitive sense is developed through consistent and conscious practice. Here's the key. You cannot shortcut this process. Intuition must be earned through focused practice and documentation. Remember, there's no single path to mastery. Encourage experimentation, adaptation, and consistent backtesting. In the upcoming slides, we'll further explore how intuition integrates into advanced trading strategies.
Let's cover the 4 principles that govern how you develop trading intuition. Principle 1. The 200-plus trade milestone. Don't skip setups based on feel until you've taken 200-plus rule-based trades. First, earn discretion through documented experience, then trust emerging intuition. This is the hard truth that most traders don't want to hear. You cannot trust your intuition until you've built a statistical foundation through mechanical rule following. Principle 2. Practice in micros or sim. Use micro contracts or demo accounts to accumulate high-volume practice. Take 40 to 60 trades per day to rapidly build experience without financial stress. This is how you compress the 200-trade milestone into a reasonable time frame without blowing up your account.
Welcome to Part 3 of 4 in Earning Your Intuition. Principle 3 focuses on process, not P&L. Emotional detachment comes through proper position sizing, allowing you to concentrate on executing your framework correctly. Profits are simply the byproduct of a proper process. Outcome bias is the biggest psychological barrier to developing intuition. When you focus on profit and loss, how much you make or lose on each trade, you train your brain to associate patterns with financial outcomes rather than setup quality. This creates a distortion in your pattern recognition. For example, you might start thinking that POC migration away from your level equals a bad setup, not because it lacked confluence, but because of financial loss. To combat this, use proper position sizing. Ensure that a single loss doesn't hurt emotionally, allowing you to focus purely on process. With trades sized correctly, losses become data points. Okay, that didn't work, let me review why. Micro-contracts and sim trading help minimize financial stress, allowing a focus on process. Ask yourself, did I classify the setup correctly? Over time, as you execute properly across hundreds of trades, profits will take care of themselves. Principle 4 encourages repetition to build recognition. Pattern recognition develops through screen time at volume levels. Over time, your brain accumulates a library of pattern exposures, manifesting as intuition. In practice, during the NY session, you might notice a mismatch in your setup pattern library and current conditions, signaling a lower conviction setup. After sufficient repetition, you'll know when to validate or skip trades based on intuition. Next, we'll continue with Principle 4, demonstrating how repetition reinforces your trading instincts. Slide 30, Earning Your Intuition, Part 4 of 4. This slide presents a vital progression path for every discretionary trader: rules, confusion, and intuition. In Stage 1, we start with rules. You follow your framework mechanically: setup classification checklist, entry criteria, stop placement, and targeting. Every action is deliberate and methodical, building your foundation. Moving into confusion, Stage 2 is where confusion sets in. As you make 50 to 100 trades, you see some A-grade setups fail, while B-grade setups succeed. Sessions may or may not respect prior levels. Confusion indicates progress. It's where you encounter edge cases and exceptions.
Keep executing your framework, document everything, and accumulate pattern exposures. Finally, after 200-plus trades, intuition emerges. Patterns that seemed random make sense. A-grade setups at PD-Val may fail with POC migrations, but B-grade setups work with HVN formations and multiple rejections. Now you instantly recognize valid setups, confirmation, and market state without conscious analysis. Remember, you earn discretion through repetition. Intuition is distilled rules compressed by experience. Strong intuition comes from rigorous rule following for hundreds of trades. Don't cheat the process. When you can assess a chart instinctively, that's true discretion. The next slide will cover valid reasons to skip trades after gaining experience, exercising the discipline to stand down based on session context, market state, and risk management. Slide 31. Valid reasons to skip after experience. Part 1 of 3. This slide covers one of the most important yet underappreciated skills in discretionary trading, knowing when not to trade. The discipline to skip protects your equity curve. But here's the critical distinction. You earn the right to trust your gut only after 200-plus rule-based trades. Beginners must follow rules strictly with no discretion yet. After 200-plus trades, you've built the pattern recognition library that allows you to skip based on feel. These aren't excuses, they're data-informed decisions from pattern recognition. Let's cover the 4 valid skip signals and why the protective mindset matters. Skip signal 1, choppy structure. The first skip signal is choppy market structure. This is when you see overlapping candles, no clear trend direction, and price grinding back and forth without decisive moves. What this looks like is price opens at 45.25, chops up to 45.30, back down to 45.22, up to 45.28, down to 45.24, up to 45.27. The candles are overlapping, long wicks on both sides, small bodies, no clear winners. Bulls can't push it higher decisively, bears can't push it lower decisively. The market is in discovery mode without conviction. Your volume profile shows this too. The POC keeps jumping around every 30 minutes. It forms at 45.25, then migrates to 45.28, then back to 45.23. The value area expands and contracts rapidly without establishing clear boundaries. There's no structure to trade against. Why skip this? Choppy structure means no edge. Your volume profile framework works because markets respect structure and fair value. When the market is chaotic and indecisive, structure doesn't matter yet. Trading in chop is gambling, not trading. You're taking random entries hoping to get lucky, not executing high-probability setups based on confluence. After 200-plus trades, you've experienced choppy sessions. You know what they feel like. When you see that familiar pattern, overlapping candles, jumping POC, rapid value area changes, your pattern recognition flags it. That's your signal to stand down. Skip signal 2, low volume periods. The second skip signal is low volume periods. This includes late session drift after 3:30 p.m. Eastern Time, lunch hour thinness from about 11:30 to 1 p.m., and overnight dead zones where participation drops significantly. What this looks like is 3:45 p.m. during the New York session. The market has been trending all day, but now volume has dried up. Your volume profile shows thin bars. Volume is 30 to 40% of what it was during the 10 a.m. to 2 p.m. window. Price is drifting slowly, and when it does move, the moves are small and lack conviction. Or it's 2 a.m. during the Asian session. You're watching ES and the volume is abysmal, maybe 1,000 to 1,500 contracts per minute compared to 8,000 to 15,000 during NY hours. Price is barely moving. Your developing POC is based on such thin volume that it's not a reliable fair value indicator. Why skip this? Low volume means low liquidity, and low liquidity means your edges evaporate. In low volume, a single large order can spike price through your level without any real rejection. Your stop gets hit not because your level was wrong, but because there weren't enough participants to defend it. And when you try to exit, the slippage is worse because there's no liquidity to absorb your order. After 200+ trades, you've been stopped out in low volume periods enough times to recognize the pattern. When you see thin volume bars on your developing profile, or when you check the clock and realize it's lunch hour or late session, your intuition says low probability window. That's your signal to skip or downgrade to micros for practice only. Skip signal 3, two perfect traps. The third skip signal is the too perfect trap. This is when a setup looks flawless on paper, but something feels like bait. Major news events are pending, or you recognize an obvious institutional trap pattern. What this looks like is you're watching for a long at PD Val 25.25. Price approaches and everything aligns perfectly. The level has strong history. It held 4 times last week. The trend is bullish on the 60-minute chart. The rejection candle is textbook, long lower wick, strong close near the high. Your developing POC is forming right at 45.25. By your checklist, this is a perfect A-grade setup. But something feels off. You check the economic calendar and realize FOMC is releasing minutes in 30 minutes, or you notice that the setup is so obvious that every retail trader on Twitter is posting about the same long at 45.25. Or you see that price approached 45.25, tapped it perfectly, bounced exactly 5 ticks, and now is hovering just above, almost like it's waiting for longs to pile in before reversing. Why skip this? Two perfect traps are institutional bait. When a setup is so obvious that everyone sees it, the smart money knows where the stops are and where the entries are. They can run the stops, trigger the breakouts, and fade the move once retail is fully committed. Major news events add wildcard volatility that can blow through any level regardless of structure. After 200+ trades, you've been trapped enough times to recognize the pattern. When a setup looks too good to be true, it probably is. Your intuition, your compressed pattern recognition is flagging that something's off, even if you can't articulate exactly what. That's your signal to stand down and wait for the post-news clarity or the post-trap reset.
Slide 31. Valid reasons to skip after experience. Part 2 of 3. Skip signal 4. Not feeling sharp. The fourth skip signal is personal state, when you're not feeling sharp. This includes poor sleep, a distracted mind, compromised emotional state, or recent consecutive losses affecting your confidence. What this looks like: you woke up after only 4 hours of sleep, or your mind is preoccupied with a family issue or work stress, or you just took 3 consecutive losses yesterday and you can tell your confidence is shaken, or you're feeling emotional, angry, anxious, or overly excited rather than calm and neutral. You sit down to trade and you notice your decision-making is slower. You're second-guessing your setup classification. You're hesitating on entries you'd normally take with confidence. Or worse, you're impulsive, entering trades too quickly without full confirmation because you're chasing to recover yesterday's losses. Why skip this? Mental capital is as important as financial capital. Trading requires sharp focus, clear decision-making, and emotional neutrality. When you're compromised, whether from lack of sleep, distraction, or emotional turmoil, your pattern recognition doesn't function properly. You miss subtle clues. You misread developing volume. You overtrade or undertrade. After 200+ trades, you know what sharp feels like versus compromised. You've traded while tired or emotional, and you've seen the results. Mistakes you wouldn't normally make. Stops hit because you entered too early. Profits missed because you hesitated. When you recognize that you're not in peak state, your intuition tells you to skip. That's your signal to close the platform, take the day off, and come back tomorrow when you're sharp.
This is especially important after consecutive losses. 3 losses in a row can trigger revenge trading, the urge to force trades to recover quickly. But revenge trading is emotional trading, and emotional trading destroys accounts. The disciplined response is to step away, review what went wrong, and come back the next day with a clear head. The protective mindset. Why skipping is a skill. Now let's shift to the right column, the protective mindset. Why is skipping a skill rather than a weakness? Principle 1. Preservation greater than action. The first principle is that preservation is greater than action. Not every level requires a trade. Your capital is safer sitting still than forcing trades in poor conditions. Many traders, especially beginners, think that being a trader means trading constantly. They think that sitting on the sidelines means they're missing opportunities or not doing their job. But professional traders know that capital preservation is the foundation of long-term success. Here's the reality. If you have a $50,000 account and you lose 20% in a bad week, maybe from overtrading and choppy conditions or trading while unfocused, you're now at $40,000. To get back to $50,000, you need a 25% return. That's significantly harder than the 20% you lost. But if you skip the bad week and preserve your $50,000, you come back the following week with full capital and full mental clarity. You can take the high probability setups that appear with confidence, and you're not digging out of a hole. Preservation greater than action means your default position is cash. You only deploy capital when the setup meets your criteria and you're in peak state to execute. Every other moment, your capital sits safe. This mindset protects your equity curve from the death by 1,000 cuts that comes from forcing trades. Principle 2. Trust your experience. The second principle is trust your experience. After 200+ trades, you've seen these patterns. Your gut saying, "This feels off," is pattern recognition at work, not fear or laziness. This is the critical distinction that separates earned discretion from beginner hesitation. A beginner who skips trades based on feel is often just afraid of losing or doesn't understand the setup. That's not discretion, that's lack of confidence. But an experienced trader who skips trades based on feel has a 200-trade library to reference. When they say, "This feels off," their brain is running a rapid pattern match. It's comparing the current setup to the best trades in their library and flagging mismatches. Maybe the POC migration is slightly different. Maybe the value area expansion isn't as clean. Maybe the volume is thinner than usual. The experienced trader can't always articulate exactly what's off. The analysis happens too fast. It's compressed into intuition. But the feeling is legitimate. It's not fear, it's data-informed pattern recognition. After 200+ trades, you've earned the right to trust that feeling. When your intuition says skip, it's because your pattern recognition has identified something subtle that your conscious mind hasn't fully processed yet. Trust it. Skip the trade. More opportunities will come.
Today we'll be discussing Principle 3, Equity Curve Protection, an important aspect of trading strategy. The key idea for seasoned traders is to recognize that skipping certain trades can prevent a cascade of negative outcomes. Imagine you're in choppy market conditions where you're tempted to trade, but you know the odds are against you. You force the trade anyway and get stopped out. Frustrated, you try to recover with a bigger trade, which also fails. This leads to multiple consecutive losses, reduced confidence, and a damaged equity curve, all of which could be avoided by skipping the first poor setup. Equity curve protection is not about maximizing trades, but quality. Discipline to pass on low-quality setups is crucial to long-term success. Skipping that first bad trade keeps your equity curve flat and confidence intact for future optimal trades. Principle 4. Mental capital matters.
This is about preserving your focus and cognitive resources. If you're unfocused or stressed, it's better to skip today's trades and return sharp tomorrow. The market will still be there, and trading under compromised mental conditions leads to more mistakes, such as misjudging POC migration or entering too early. Understanding these principles helps shape the mindset. The best traders aren't the ones making the most trades, they're the ones making the best trades and applying patience and selectivity for edge. Following rules strictly before 200-plus trades ensures reliable judgment and earning the right to discretion. Next slide preview. We'll shift from theory to practice with homework assignments, applying your skills by locating perfect A-grade and B-grade setups from real market data. Remember, true intuition is pattern recognition earned through experience.
All right, it's time for your most important homework assignment yet. This is where theory meets reality, and your learning transforms into actual trading skill. Your mission is crystal clear. Find one perfect A-grade setup from the past week during the New York session, specifically between 9:30 a.m. and 4 p.m. Eastern Time. Why is this so critical? Because A-grade setups are the backbone of consistent profitability. These are the trades where everything aligns. Level history is pristine, the trend is clear, and the trigger is decisive. When you learn to recognize these setups instantly, you're training your subconscious to filter out the noise and focus only on excellence. Task number 1. Define the window. Start by locating a setup specifically within the New York session liquid hours from 9:30 a.m. to 4 p.m. Eastern Time. This is non-negotiable. The New York session is where A-grade setups shine brightest because volume and participation are at their peak. Confirm the time window strictly between 9:30 a.m. and 4 p.m. Eastern Time. Verify your instrument. Use ES or NQ futures for precise liquidity and volume profile data. Look for visible participation spikes. An A-grade setup should have obvious volume at key levels with increased delta or larger candles. Task number 2, verify context alignment. Ensure the trend, levels, and momentum align perfectly. Trend alignment means higher lows or lower highs across both 1-minute and 5-minute structures. Level interaction should occur at significant volume profile levels like previous day's value area low, high, or point of control. Task number 3, confirm the trigger. Identify decisive candle patterns like a strong rejection wick or an engulfing candle that displays confidence. For A-grade setups, your entry is aggressive on the next candle open after the trigger. A-grade setups reward speed and clear decision-making. Once found, screenshot the chart, annotate it, and save it in your Golden Setups folder. Reviewing these examples daily trains your subconscious, helping you recognize excellence in real time. This homework bridges passive learning with active mastery. Next, we'll shift gears and tackle the B-grade homework assignment, where you'll identify a valid trade during the early overnight session.